Good morning and welcome to the Killik podcast for Friday the 18th of September. So no change last night to the interest rate in the States. So the Fed were looking for a little bit more time to assess what the volatility in equity markets and the Chinese slowdown is doing to their economy. Here we've got the forward curve for rates in the US, which is decided by the Fed in terms of their expectations. As you can see, it's a fairly shallow curve with a longer term rate of 3.5%. The impact from markets is basically more of the same. And here we've got two stocks just to show the difference in performance since 2010 between those on the low inflation side of the trade and those on who benefit from more inflation. So we've got Nike here, a consumer stock, benefits from low interest rates. It's been obviously an extremely good performer, rebased at 100. Now around 300. And then you've got Shell on the other side, a beneficiary of higher oil prices, which obviously hasn't been the case, and that share price has struggled. But it's that differential in performance which is now starting to interest the market, and what we're hearing a lot of people talking about. And the outperformance that you've had by being underweight the oils and the miners has now something that some managers are looking to lock in by removing their underweight in these underperformers. So what we've seen over the last few weeks is the relative strength of the mining industry and the oil and gas industry start to pick up. And these relative strengths just mean that if the curve is going up, it's outperforming the market in general terms in that sector. That's despite further downgrades occurring in the EPS numbers, particularly in the miners following Glencore's numbers. And here you can see further downward momentum in the oil and gas producers in terms of their earnings per share estimates. So the question is, are markets going to preempt that rise in earnings? I think that the answer is almost certainly yes. But what are they going to use as the barometer for preempting that? And perhaps it's the Chinese data. So despite the Chinese market continuing to deteriorate over the last couple of weeks, we have seen a stabilization in the leading economic index in China. That's the sort of forward-looking numbers that come out of that economy. And also in the money supply, which has bounced quite markedly. Which is always a good sign of further economic activity and perhaps a growing rate of growth. So just going back to the Nike story, because we've got their numbers next week, we think the numbers will be solid. There's room for a positive surprise because there have been concerns over the momentum in the US and the Chinese numbers. Margins, we feel, will continue to climb higher. Obviously, the direct beneficiary of lower commodity prices, but we're also seeing this digital initiative, this drive into the digital economy, continuing to put upward pressure on their margins. As you can see here, a very impressive progression in that gross margin number. So next week, as I say, we've got Nike on Thursday. The other Killik & Co stock is Accenture, also on Thursday. We feel that the recent volatility in markets has offered a really good entry point for Accenture. This is a business that we've written a buy note on relatively recently. And the key, very general, basic principle behind the idea is that to a greater or lesser extent, almost all businesses are going to have to access the digital economy in some way, shape or form. Clearly, with wage growth starting to come through, we need to address the productivity issue. We've talked about this many times before, and that can be solved to a large extent through accessing the digital economy. So Accenture is the market leader in this space. They're seeing far better growth rates than any other competitor. Their digital consultancy business is 30% is growing at 30%. And they have some natural advantages, such as being extremely global, their expertise in industrial, and the amount of investment they put into digital over the last 4 or 5 years. So the business, we think, will continue to grow. We're in the very early innings of growth or of the digital economy, and old economy stocks accessing it. and this business is very disciplined in terms of paying back cash that they receive to shareholders. And as you can see from this chart, cash return to shareholders has been increasing materially over the last few years, whether through raised dividends or through buybacks. So that's it from me. Thanks for listening. Have a good weekend.